Mumbai, we're in Mangalore, we're in Kochi, we're in Haldia, but there are some new ports that we are not present in. New ports as well as older ports. And I think we need to finish that necklace of terminals, and so that every major gateway that the customers into India, that customers want to access, we will be present. But this is very important phrase, inland locations. I mentioned that it's no longer, the business is shifting now, no longer just port-based locations, terminals, but actually terminals, inland terminals as well, or inland depots, as we might call it. Even the national oil companies, IOC, HPCL, BPCL, and other customers, if we can offer them that, look, not only we can handle your products when they're imported or exported through the port-based terminals, but we can even handle your inland logistics in various hubs, inland. This is something that is the new direction in which the logistics and terminals business is going in. So these are all very important indicators of where the strategic direction of this terminals business is going. And needless to say, there are always increasing competitive threats. Aegis is a clear market leader. There's no doubt about it. But there are a number of customers, and we need to stay ahead of the game in terms of our brand position, that we are the quality player in the market, yes, with competitive rates, but competing with all sorts of players, some of whom are, should we say, disorganized and cowboys, some of whom are more significant. And we need to keep that market leadership position, not only for the next 5 years, but the next 20, 30, 40 years. This is a very crucial thing. So we actually did this strategic thinking as to what's next for this terminals business that we have, to do new things, to accelerate the growth and take advantage of these growth opportunities. And therefore, we began a search for international partners 2 years ago, 2019. We started looking for international partners who could enhance the Aegis position in this terminals business, both LPG, liquid chemicals, petroleum, but also diversifying into new areas of tank storage as well, to keep the growth going for the next 10, 20, 30 years plus. And we felt that we could look for an international partner who could bring that kind of know-how, who could bring the kind of brand presence, and who could bring the capabilities that we did not have, but who could add to the capabilities that we had. So let me talk slide 8 about the background of the deal. As I said, the Aegis management initiated discussions with a number of strategic and financial partners from 2019. And as a result of that process 2 years ago, Royal Vopak emerged as the preferred partner. As I explained earlier, they are a strategic investor. They are the world number one, the leading company in this business of tank storage. And therefore, obviously, once they showed a lot of interest in this, they became the preferred partner for financial as well as even more important strategic reasons, that they were the best partner, we thought, out of all the potential partners that had been shortlisted. And as we announced on Monday night through the press release in Amsterdam, as well as over here in Mumbai, the transaction was approved by both the Aegis board of directors on Monday night and the Vopak board as well. So the transaction has been approved by both boards at long last. I can just mention, if I may, doing a negotiation virtually through WebEx meetings and Google Meets and all that, while the Indian teams of Vopak and the Aegis management team in India have been able to meet face-to-face several times through all the COVID restrictions. and due diligence took place in terms of site visits and all that from the Vopak teams. But at least at, should we say, the chairman and CEO levels and etc., we had to do all our discussions and negotiations virtually, which was challenging, and it increased the time it took to close the deal. We thought this deal might be closed earlier, perhaps even as early as March, but finally we were able to approve it by July. So we had challenges, but I think an excellent relationship has been built up over many months in terms of this negotiation, not only by the teams, the management teams in Vopak India, but also the Aegis management team in India, but also at Raj and my level, meaning chairman level, with the equivalent, our equivalent counterparts in Vopak in Singapore and in Rotterdam. Now let me go through the transaction highlights, and this is where it's now going to start getting, although as I said, I'm sure most of you have read this, but now let me go through carefully because it is a complex transaction. So I already mentioned on the left-hand side, the proposed name of the joint venture company will be Aegis Vopak Terminals Limited, AVTL, which will be a 51% subsidiary of Aegis Logistics Limited and 49% owned by Vopak India BV, which is their Netherlands company, Holland company, Dutch company, for investing in India. So they will own 49%, and 51% of this joint venture company, Aegis Vopak Terminals Limited, will be owned by Aegis Logistics Limited, the publicly listed company. And we are proposing, as I talked about, to combine our existing tank terminals business in India into this joint venture company. The combined business will initially have a storage capacity of 960,000 cubic meters or kiloliters. This includes not only the liquid terminals, but also the LPG terminals converted all into cubic meters. So that's the figure of 960,000. Just shy of 1 million cubic meters will be this joint venture company. Now, the highlights of this. This is very, very crucial. AVTL will acquire 100% of the business and assets of the following units from Aegis. So these are the units that we are transferring into the joint venture company. The first unit is the Kandla and Pepa LPG terminals. Kandla LPG terminal is still to be commissioned, but that's the one under construction. The Pepa LPG terminal. So the Kandla LPG terminal and the Pepa LPG terminal will be transferred by Aegis into this joint venture company. The Kandla liquid terminal and the Pepa liquid terminal will also be transferred into this joint venture company. So those are the liquid terminals in Kandla and Pepa. In other words, the Gujarat terminals, both gas and liquid, of Aegis will be transferred into the joint venture company, and I'll come to the financial details in a little while. The Mangalore and Haldia liquid terminals will also be transferred into the joint venture company. So these are all the terminals that we are currently going to be transferring into the joint venture with Vopak. I repeat, the LPG terminal in Kandla, the Pepa LPG terminal, the Kandla liquid terminal, the Pepa liquid terminal, the Mangalore liquid terminal, and the Haldia liquid terminal will be transferred into the joint venture company. In addition, the Kochi terminal, which is owned by a subsidiary called Konkan Storage, that was an earlier acquisition that Aegis has done, so therefore it's a 100% subsidiary currently of Aegis. The joint venture company, AVTL, will acquire 100% of the shares of that. Although we're not transferring the assets, the joint venture company will own 100% of the shares of the Kochi terminal. So that will also be part of the joint venture. In addition, we have agreed that Vopak will acquire 24% of the share capital of Hindustan Aegis LPG, which is the Haldia LPG terminal. Now, most of you will remember that we already have an existing joint venture with Itochu Corporation of Japan through their Singapore subsidiary, where they have 25% already, and Aegis through its subsidiary owns 75% of the Haldia terminal, HLPG. We went into three-party discussions between Itochu, Vopak, and us, Aegis, that look, Vopak wanted to also come into this terminal. And what was agreed was that between the three partners, that Vopak will acquire 24%. Aegis will then dilute down from 75% to 51%, and 25% will remain with Itochu. Obviously, we received consent from Itochu as per our shareholders agreement for this transfer to a third party. By the way, I can just mention, without going into too many details, after several discussions with Itochu explaining this transaction in full, including what we want to do with Vopak in India as well as in Northeast India in Haldia. Itochu was quite excited about the prospects. They know Vopak very well. Any energy trading company will know Vopak because they obviously use Vopak worldwide. So they were excited to hear about this transaction. And once we were able to go through the details, we organized a virtual meeting between Itochu, Vopak, and Aegis to explain the deal and also to talk about the various opportunities. And Itochu, rightly in our view, saw great scope for the potential of this Aegis Vopak joint venture, and indeed Hindustan Aegis LPG, where we have the tripartite joint venture now. Once this transaction closes, they saw great advantages and opportunities of the three companies working together in many different areas, specifically first in the Northeast India region with HLPG, but we've agreed to talk about many other opportunities going forward between Aegis, Vopak, and Itochu. So that's a very powerful combination for the future, starting, as I said, in HLPG in Haldia with the LPG business, but that we are not only the power of Aegis in India, but the power of Vopak, but also potentially Japan's leading trading company, Itochu. So a very, very crucial thing which I would say now to clarify is it was part of the deal that Aegis will continue to 100% own and operate all the terminals in Mumbai that Aegis has. That means the Mumbai 2 liquid terminals, the sea load containers, as well as the Mahul terminal, as well as the Mumbai LPG terminal. That was part of the negotiation, and we basically said that we would like to retain the 100% ownership of these Mumbai terminals, which was the, shall we say, the core and initial starting point of the Aegis terminals business. So the joint venture company, Aegis Vopak, will not be in Mumbai. That will remain 100% owned Aegis, but all other ports, including the current ports that we're talking about, is available for Aegis Vopak Terminals Limited to expand into, with the exception of Mumbai, which will remain 100% owned Aegis business. And finally, Vopak themselves have a terminal in Kandla, which they've been operating for a number of years. This is a company called CRL Terminals with a capacity of 250,000 kiloliters. Remember that Aegis already has a capacity of 140,000 kiloliters in Kandla for our liquid terminals. So we have agreed as part of the deal that the joint venture company, Aegis Vopak, will acquire 100% of the share capital of CRL Terminals from Vopak India, and that will ultimately be 51% through the joint venture company will ultimately be owned by Aegis of CRL Terminals, and 49% by Vopak, because that's the shareholding structure of AVTL. Okay, so that's part of the whole financial transaction as well, that the joint venture company will also be purchasing from Vopak, just like the joint venture company will be taking assets or acquiring assets from Aegis, the ones that I mentioned. There will also be a purchase of the CRL terminals, and that was a negotiation. I can just tell you that just a couple of things about Kandla. As most of you know, Kandla is the #1 POL, petroleum, oil and lubricant port in India. It is the busiest port in India for handling petroleum, oil and lubricants. So it's a very crucial thing. So we will now have 2 terminals at the moment. The Aegis in the joint venture company with Vopak, not only the Aegis existing 140,000, but an additional 250,000. And I can indicate that we want to grow further in Kandla, as I said, the busiest port, very, very crucial gateway for North India. This was an important consideration for us as well as Vopak, that look, how can we jointly, Aegis Vopak, do more in Kandla? We'll be a very powerful presence in Kandla, Aegis Vopak together. Of course, the LPG terminal, massive LPG terminal is also coming up, which Aegis Vopak will own, but also the liquid terminals that we just talked about. So I think this is essentially the highlights of the transaction, really concentrating at the current time on the liquid and LPG terminals, with the exception of Mumbai, between the 2 companies. Now, the next slide, really on slide, I think it is slide 10, really shows the boxes in terms of the corporate structure. You can see Aegis Logistics Limited there in red. It will continue on the left to own 100% of the Mumbai LPG terminals, the Mumbai liquid terminals, the retail LPG distribution business, which I'm going to be talking also more about in this presentation, and the marine fuels in Singapore business. These will all remain within Aegis, and we'll be growing those 100% owned businesses within Aegis, outside the scope of the joint venture with Vopak. But we will be growing. That's a major part of the growth story for Aegis Logistics Limited as a whole. But as I said, Aegis Logistics Limited will also own 51% of the Haldia LPG terminal, that is HA LPG, and Itochu will own 25%, and Vopak will own 24%. So that will be another unit of Aegis Logistics Limited, which is 51% of the Haldia terminal. As we've just discussed, Aegis Logistics Limited will have a 51% share stake in Aegis, the Aegis Vopak joint venture company, with all those terminals. This will become a major joint venture with Vopak, which in turn, as I've already explained, will have 200% subsidiaries. One is the Kochi subsidiary, and the other is the Kandla CRL facility terminal, liquid terminal, which will both be 100% subsidiaries of Aegis Vopak joint venture company, Aegis Vopak Terminals Limited, of which obviously Aegis owns 51%. And we will continue with the sourcing subsidiary in Singapore, AGI, Aegis Group International, where Aegis Logistics owns 60%, and Itochu Corporation, Itochu Singapore, will continue to own 40%. So that obviously, so what you can see here, very clearly defined, is that Aegis Vopak Terminals will be concentrating on certain businesses which are related to terminals and tank storage. Vopak is not interested in the distribution business, the retailing business. They're not interested in trading and sourcing. That is the Itochu business. But basically, anything to do with terminals, and I'll say more about it in coming slides, outside of Mumbai, this joint venture will with Aegis Vopak. That will be the vehicle for growth, and tremendous growth that we are planning in that vehicle with Vopak, as I'll explain. That will be the vehicle for growth. But what I really want to emphasize at this stage is Aegis will continue to grow its Mumbai terminals, particularly the LPG, which we think there's scope for that. And most of all, Aegis is going to continue to grow the retail LPG, where we'll be 100%, a very high margin business where we've got a long way to go to scale up that business. And when I say long way to go, I'm talking the next 10, 20 years of growth plus in terms of the retailing, particularly the Aegis auto gas stations and the cylinder business, both for the domestic segment, the Chota Sikandar cylinder segment, as well as the Aegis Pure Gas commercial segment, where we are going national. In fact, this is going to become a major part of the Aegis Logistics Limited growth story, the retail LPG business over the next 10, 20 years as we scale up. And we will have not only the financial resources, but more important, the management resources to really grow this retail business, which we think is going to create significant value for the Aegis shareholders. Nothing to do with Vopak, that's a different joint venture, but this is to do with this business. Okay, then we go into the next slide, which is what will the Aegis business structure look like post-transaction. The earlier slide was the corporate structure. I think it's very clear to see that Aegis will really have three legs. You might call it four legs, actually. One will be the LPG retailing business, where we will have 100%. That's one leg of the business. A second business will be the Mumbai terminals business, which is not only the liquid terminals, what we call M1 and M2, Mahul 1, Mahul 2, but the Mumbai LPG terminal as well. And the third leg is the LPG sourcing business that we have in Singapore with Itochu, where we are purchasing and selling gas into India with Itochu. And fourth and finally, this new joint venture for the tank terminals business in current ports of Kandla, Pippa, Haldia, Mangalore, Kochi, current but not the only ports, but for now, the joint venture company in tank terminals with Vopak, Aegis Vopak Terminals Limited. So these will essentially be the four business lines of Aegis: LPG retailing, Mumbai terminals, Aegis Vopak terminals, and then the LPG sourcing business. Maybe, yes, I can say in the terminals business, the joint venture for Haldia LPG as well. Either we can call it fifth business, or we can say it's part of the terminals business. Okay, now I intend to go through the financial details of the deal. What we have declared, and I'm going to spend maybe a little bit of time on the valuations as well to see how we negotiated these payments to Aegis, the cash amount that Aegis will receive pre-tax on this conclusion of this deal with Vopak. And bear with me, because I think a lot of people would want to know the details of how we came up with these numbers as far as. So let me start. I'll come back to this slide in 1 minute, but let me start. And these figures are not on the slides. I'm going to say it verbally. Please write it down for those who want to, who are interested. As I said, the units that are being carved out of Aegis and put into the joint venture with Vopak are the following. This is the list that I'm reading out from my iPad. These are the 8 units that we are carving out of Aegis and transferring into the joint venture with Vopak. One is the LPG Kandla terminal. Number 2 is the liquid terminal in Kandla. Number 3 is the liquid terminal in Haldia. Number 4 is the liquid terminal at Mangalore. Number 5 is the liquid terminal at Pippa. Number 6 is the LPG terminal at Pippa. Number 7 is the 24% stake in HALPG, the Haldia LPG terminal. And number 8 is 100% of the shares of the Kochi liquid terminal. Okay, so I hope that's all clear. I've repeated the same list before in the previous slides. So I think what would be very helpful to participants is what does that represent in terms of valuation that we really agreed with Vopak in terms of enterprise values. And what we've done is we've added up the forecast EBITDA for FY22. So this is a prospective EBITDA, not historic, because obviously there are some expansions going on in which are coming in the revenues of Mangalore Liquid, etc. So when we negotiated with Vopak, we looked at the obviously future cash flows, but for purpose of this call, let us look at the forecast for EBITDA for all these units together, the 8 units that I mentioned. So what we've done, the forecast EBITDA of FY22 for the gas units that we are transferring. That means Kandla, Pippa, and Haldia gas terminal. The prospective EBITDA for FY22, we have forecast 176 crores. Okay? 176 crores for the forecast EBITDA of the gas units that we are transferring in that list of 8. The gas units, the gas businesses that we are transferring into this joint venture, we forecast 176 crores of EBITDA for FY22. Similarly, the liquid units that we are transferring of that list of 8, we forecast the EBITDA for FY22 of those units being transferred at 72 crores. So 176 crores of EBITDA for the gas units, 72 crores of liquid EBITDA that we are transferring. So if I add up 176 plus 72 crores, a total forecast of EBITDA of 248 crores. That means 176 plus 72 equals 248 crores of EBITDA that we are transferring into this joint venture company. And I take we have basically negotiated a multiple of 23 multiple of EBITDA with Vopak. That's the implied multiple that we have agreed in terms of the negotiation. The enterprise value for all these units that I mentioned is 5,704. That means 248 crores of EBITDA times 23 multiple comes to 5,704 crores. That is what we negotiated with Vopak. The implied multiple was 23, which I think most will agree is a significant multiple, 23 times forecast EBITDA. Not historic, remember, but forecast of 2022, 23 times multiple. Now, 5,704. If we subtract the Haldia enterprise value of 1,308 crores, why do I say Haldia enterprise value? Because when we look at the 24% that Vopak is buying of Haldia LPG, that means HLPG, it translates to a enterprise value for the whole company of 1,308 crores. Okay, that's, by the way, that is the same value that Itochu negotiated just now, literally in March, April I think it was, for Itochu acquired an extra 5.3% in HALPG Haldia and around 69 crores. So that means around the same kind of valuation that Itochu did, 1,300 crores, and that's reasonably the same valuation that Vopak did pretty much in terms of they paid the same value that Itochu did literally in April. Now this is in July. This is of course is based on the discounted cash flows, future cash flows of HLPG Haldia, which has been running for 3 years, but basically take into account what are the kind of forecast volumes, sales volumes from HPCL. It was an issue with both Vopak as well as in the negotiations, as well as Itochu, that now BPCL has gone out because they commissioned, as you all know, they commissioned their terminal in December 2020. So looking at that, what was a reasonable valuation, and I think both of them independently came with a similar kind of figure, and we finally agreed that. So coming back to our transaction, I said that the enterprise value of the units that we are transferring was 5,704 crores, which includes Haldia, which represented a 23 times implied multiple of EBITDA. But if we subtract from that the Haldia enterprise value of 1,308 crores, the remaining units, which means the Kandla units and the Pipau units and the Mangalore, etc., and Kochi, the remaining units, the enterprise value is 5,704 minus the Haldia 1,308. That implies that the remaining enterprise value for those units was 4,396 crores. Okay, 4,396 crores was basically the enterprise value that we negotiated with Vopak for those remaining units, excluding Haldia, which we already talked about, 1,308 crores. And if you take 49% of that enterprise value of 4,396, which is what Vopak is acquiring, 49% is the enterprise value. 49% of the enterprise value of 4,396 for all the units that we're transferring into the joint venture company. 49% of 4,396 comes to 2,154 crores. So 2,154 crores is what essentially Vopak is valuing its 49% stake. And then you have to add the HA LPG stake, which they're paying 314 crores on top of that for 24%. In other words, 24% of 1,308 crores of Haldia, that represents 314 crores. So if I do 2,154 crores, which is the 49% of all those units that are being transferred, plus the 314 crores that they are paying for the 24% stake in HLPG, that comes to 2,468 crores is what they are supposed to pay. And actually, that is really the kind of way that it was done. But actually, it ends up that we're getting a little higher amount of 2,766 crores. So a little higher amount than 2,468 crores if certain performance incentives are achieved by year 3. And so what we did was we were not happy with just 2,468 crores. Our team actually negotiated some additional payments of up to 198 crores. Basically by year 3, if the business achieved cumulative revenue goals in the next 3 years, Aegis Vopak Terminals Limited, then Vopak would pay additional amount of up to 198 crores in year 3 to Aegis. So Vopak paying directly to Aegis. Therefore, now going back to our slide over here, this really is how we generate this figure of the payment to Aegis will be 2,568 crores of cash plus potentially an additional 198 crores by year 3 on achievement of revenue projections up to, so they will be a little less than 198 crores if we achieve only certain part of those milestones, revenue milestones. But if we achieve 100% of those milestones, and by the way, we are actually reasonably confident we will achieve those revenue milestones, then we'll get the full 198 crores addition cash from Vopak, euro equivalent, which is I think 40 million euros, equivalent to 198 crores. So therefore, we can now say that the total cash pre-tax cash consideration to Aegis from this transaction will be in the range of 2,568 to 2,766 crores from transferring these units, the 8 units that I mentioned, plus the 24% stake in Haldia. That's a substantial amount of cash which will be sitting in the balance sheet of Aegis Logistics Limited, and I'm going to explain in coming slides what the utilization of this cash, because you do not expect Aegis and you do not expect me to say that we're just going to sit and put that in the bank, this 2,766 crores. I hope not, because I think all of you, as we are excited by the growth opportunities that we can deploy this cash. This is essentially the transaction details. I've gone through in the last 10-15 minutes how the justification of the valuation of the units being transferred to Vopak, and how we came up with those valuation figures. Obviously, it was a negotiation based on future cash flows of each unit, and then etc., the net present values and all that. But also, I've explained how the amount of EBITDA that will be carved out of Aegis, for example, in this current financial year, FY22, of around 248 crores of EBITDA will be carved out of Aegis Logistics, transferred into the joint venture company. 51% of that, of course, will continue to be owned. Those EBITDAs will, in accounting terms, equity accounting terms, be owned by Aegis, 49% by Vopak. But I think you will agree with me, and I hope you do, that we have achieved a full price, a 23 times EBITDA multiple for that value of for that EBITDA of 248 crores. Now, before I go forward, some of you will be interested that, okay, can we understand the rest of the valuation of Aegis? What about what is remaining in Aegis, and how? What is the kind of value of the businesses remaining in Aegis, and what are the kind of EBITDAs that will remain with Aegis? So let me go through that because this is an Aegis presentation, not only the presentation of the joint venture company. So what I can tell you is that what will remain in Aegis, the Mumbai gas terminal, plus the retail LPG distribution and sourcing business. That is all the gas businesses of Mumbai plus the sourcing and the retail distribution business. The EBITDA we expect in FY22, the forecast is 236 crores of that will remain. The gas, Mumbai gas terminal, the LPG retailing business and the sourcing business, our share, will be about 236 crores in FY22. That EBITDA will remain in Aegis. In addition, the two Mumbai liquid terminals, we forecast around 110 crores of EBITDA for FY22. So a total EBITDA of 236 crores for the gas business and 110 for the liquid business. Total EBITDA of 346 crores will remain in Aegis. So we are transferring 248 crores into the joint venture company, but we are retaining 346 crores of EBITDA for this financial year. And if I take the same multiple of 23 that we have ascribed to the valuation that we did with Vopak to these businesses, and why not? If we're able, that is through Vopak transaction, we validated that 23 times multiple. If I do 346 crores of EBITDA of the businesses retained by Aegis, multiplied by 23, a multiple of 23, I come up with 7,958 crores of valuation retained by Aegis Logistics Limited. So the business is 100% retained by Aegis, which is Mumbai, still represents almost 8,000 crores, 7,958 crores retained by Aegis Limited, Aegis Logistics Limited. On top of that, we retain 51% of the 1,300 crore enterprise value of Haldia, and on top of that, we retain 51% going forward of the Aegis Vopak Terminals Limited business, which will be growing in value over time. But I've already explained what we and Vopak ascribed the valuation of that business, which I said was 4,396 crores. So that represents will represent the Aegis, shall we say, total valuation, the breakup value of Aegis. We break it up into parts. That we come up with 7,968 crores of value from the businesses retained by Aegis, including the Mumbai liquid and gas terminals and the retail distribution business and our share of the sourcing business, and 4,396 crores currently, that is our 51% of that, and the 75% of the Haldia enterprise value of 1,300 crores that I mentioned, or 1,310 crores. That will represent the so-called market cap of Aegis going forward. The idea is clearly we will be growing all three parts of Aegis going forward, and I will explain how the enhancement of Aegis shareholder wealth will take place, because we intend at Aegis to now significantly grow over the next years the businesses retained by Aegis. That means the LPG retailing business, the distribution business. We significantly see extra growth coming from that. We see growth coming particularly in the Mumbai LPG business, which I'm not going to explain today, but we have got plans in that. These are Aegis plans alone. We have got growth plans in Haldia with Itochu and Vopak agreed, and I will not go through all the specifics, but we'll give you a flavor. And of course, I will be explaining more about the huge growth plans that the Aegis Vopak Terminals entity, the joint venture company, has over the next 5 years and beyond, over the next 10, 20 years, which will significantly enhance when you add up all three parts of Aegis. The businesses retained by Aegis, the Aegis Vopak Terminals Limited 51% stake, and the 51% stake in HALPG. All three of these businesses we are going to be expanding, and the total of all those will be the kind of market wealth, or market capitalization, stock market wealth of Aegis going forward, all going up. Just before I move on, and I hope that is helpful, of course, in Q&A we're happy to answer further questions on those valuations and the cash reconciliation, etc. But the figure to really understand is that we have two things I want to get across. I hope I have been able to do that. We are transferring a certain amount of EBITDA into the joint venture company, but retaining quite a bit of more of EBITDA in Aegis through Mumbai and the retailing, LPG retailing. But we've got a full value, 23 times EBITDA multiple from Vopak for the businesses that we're transferring. And second thing I'd like to really people to understand is how we have how that actually realizes into a potential payment of 2,766 crores into Aegis. These are actual cash amount, which pre-tax, which will be received by Aegis into its balance sheet, available for future capex and growth, which I'll explain. I would just like to say a couple more things before I move on, which is we expect on closing of this transaction, which will take place in a few months' time, and I'll explain that in the next slide. We expect on closing of this transaction that out of this 2,766 crores, around 75% of that cash will come into Aegis at the time of closing from Vopak and this whole transaction. In other words, 2,074 crores, 75% roughly of that 2,766, 2,074 crores cash will be in the Aegis balance sheet by the time we close this transaction, and about 25% additional payments after 3 years or so, which means around 692 crores. These are the extra payments that Vopak will make directly to Aegis, etc., that I already explained. So that's how we come with a total of 2,766 after a few years, but the 75% bulk of it, 2,074 crores, will be coming on closing. Now, I said pre-tax. Clearly, there will be taxes to be paid by Aegis as applicable on the transaction. These are Aegis has to pay taxes as sellers of those units. We'll have to pay a certain amount of tax, which will come out of this cash pile of 2,766. We have those are complicated calculations, but obviously we've been advised by our tax advisors on shall we say the best way to handle those taxes. But there will be a very large after-tax cash amount after these taxes are paid. And I would like to also explain to you that Aegis Vopak Terminals Limited will assume certain amount of external bank debt, but we have agreed with, so what we discussed with Vopak was what is an appropriate capital structure for the new joint venture company, Aegis Vopak Terminals Limited. They have certain policies that certain financial policies that they follow. Aegis has certain financial policies that we follow. So what is an appropriate capital structure for this terminals business, heavy cash cow, generating heavy cash cow? We agreed that it was not appropriate to have zero debt in this joint venture company, but we thought, especially with vis-a-vis the huge capex program that I will be explaining soon, well, we agreed that a certain amount of external debt following conservative leverage, debt to equity ratios, and debt service ratios, which we have agreed between Vopak and Aegis, which are written into the shareholders agreement. So with a certain conservative leverage and ratios and debt ratios, that there will be a certain amount of external debt in Aegis Vopak Terminals Limited. And future capital expenditure of Aegis Vopak, which I'm going to explain in some detail, will be funded by a mix of free cash flows of the joint venture company. Obviously, it's going to be generating, throwing off lots of cash from these terminal businesses that are there, including the CRL business in Kandla. And there will be some project debt. We'll take on some debt, as I explained, but also both parent shareholders, Vopak and Aegis, as required, will need to inject further cash injections into this joint venture company. That obviously that gives you one answer, that what is this cash of 2,766 crores minus tax in the balance sheet of Aegis? Some of that, quite a bit of it, will be recycled into the investment program that we have over there, which I will explain in a little bit. Okay, let me just take a drink of water. Right. So we have now gone to the transaction timetable slide 13. I'm conscious of time, so I will try and finish, but we have to finish this presentation. The transaction timetable on slide 13 is board approval by both the Vopak Supervisory Board and the Aegis Board has been received, as I mentioned. So both boards have approved the deal, transaction in full, including all the legal agreements necessary. We will, at Aegis, require a special resolution by the Aegis shareholders, because obviously there is a sale of substantial assets. Not only the board approval, but shareholder approval is required, and we'll be doing that through a postal ballot. Probably it will take 45 to 60 days to conduct that postal ballot. Assuming that the Aegis shareholders approve this transaction, there will be a number of regulatory approvals and transfer of licenses and permits that need to be done for each entity. For example, transfer of explosives licenses to Aegis Vopak Terminals Limited from Aegis Logistics Limited, certain port permissions, all those kind of things, which will take a few months, we expect, because each one we'll have to go through. It's a laborious process that we have to go through. So we expect to complete this deal before March 31st, 2022. In other words, although we're announcing this deal in July, it will take probably 6 to 9 months in total of getting all the permits before this transaction completes. There are several conditions precedent, etc., including these transfers that we need to do. And only at that stage on closing, does Aegis receive the cash and Vopak pay its amounts and all the rest of it. Okay, now I'm going to talk a little bit about the management and the board, because this is important. I won't spend too long on it, but I think some people would like to know how are we going to manage this, that we are 51% at Aegis and 49% is Vopak. So what we've agreed is that there will be a board of 6 members, 3 of which will be nominated by Aegis, 3 of which will be nominated by Vopak. The chairman of this joint venture will be an Aegis chairman. It will be probably Raj. Raj Chandara, as the chairman of Aegis, will be the chairman of this joint venture company, and he will have a casting vote. In other words, where there's a deadlock in certain procedures, or not, where there's a disagreement, he will have the casting vote as a 51% shareholder. Of course, that is subject to certain minority rights, standard minority rights that Vopak has requested in the shareholders agreement. These are very standard minority rights. And there will be two other board members along with Raj, one of which will be myself, and we will nominate one more board member. So three of us will be on the board of the joint venture company, and Vopak will in turn nominate three board members, so 6 members in total. Now, the management organization, very crucial. Obviously, the board of directors I mentioned, but there will be a management committee running the business on a day-to-day basis. This will be a president nominated by Aegis, a president of this joint venture company. There'll be a joint president nominated by Vopak, and there will also be a chief operating officer, COO, and a CFO, chief financial officer. This will constitute the management committee. In fact, both we as well as Vopak have requested that at every board meeting, the management committee, these 4 people, should be invitees to the board meeting so that the board of directors can be briefed on the actual business going on. And this management committee will supervise the various operations of the joint venture company, including the commercial, liquid commercial team, the gas LPG commercial team, the finance department, the CFO, the HR, human resources department, and then there will be a COO, as I mentioned, a chief operating officer, who is underneath the president and joint president for day-to-day operations, and the CTO, which is chief technology officer, both of which will be nominated by Vopak. We fully expect that obviously the existing terminal operations, they all have, these are the Aegis units and the CRL unit of Vopak. They have their own terminal manager already, and all that structure. They will be there transferred into the Aegis Vopak Terminals Limited as employees of that. But we fully expect that the Vopak full access to the Vopak management team, global management team, for help, particularly from their Singapore office, which is the Asia Pacific office of Vopak. Full support from Vopak Singapore, Vopak Asia, in terms of terminal operations and standards and all that. It's a big advantage that while each site has its own terminal managers and operations people, there will also be a lot of coordination required with the Vopak team in Singapore as well. But overall, the joint venture company will be run by a management committee, a joint management committee. Okay, now we're coming to slide 16. I'm almost coming to the end. So why did I say this is a win-win partnership for Aegis and Vopak? Listen, there are 9 reasons we put here. A co-branded terminals. We've agreed that the Aegis Vopak will become the new brand name. Aegis logo as well as Vopak logo. Aegis Vopak will become the brand name for terminals, with the exception of Mumbai, in India. And I think everybody, the customers know Aegis. A lot of people in India and worldwide know Vopak. But I think it'll be a very strong and #1 brand name in India for the terminals business, Aegis Vopak. We will also be together servicing the customers of both companies, including the national oil companies, multinational companies, specialty chemical companies, and traders. That means Aegis Logistics existing customers will now become Aegis Vopak customers. Vopak customers who are coming into India, including national oil companies, multinationals, will will also become members of the joint venture, become customers of the joint venture, Aegis Vopak. There will be a all-India, pan-India footprint. Clearly, Aegis is already present in most areas of India with the necklace of terminals, but we will have a complete footprint with Vopak. We will have access, as I said, to the global best practices for environmental standards, sustainability, safety that Vopak has. Aegis already has very high standards, but we can go even further with access to Vopak's best practices. That was extensively discussed by us with the Vopak team, and is an important part of the consideration that going forward, all the Aegis Vopak terminals will really be world-class in terms of the environmental and safety standards. But there is a great potential for consolidation in the Indian market and increased market share by Aegis Vopak. Not going to say too much about it, but this combined entity, Aegis Vopak terminals, will be a very powerful presence in the Indian market, and there will be opportunities. I know that for a fact. There will be opportunities for acquisitions and consolidation to take over weaker terminals and really add that to the portfolio of Aegis Vopak. There will be further diversification of the customer base for both companies. Obviously, Vopak will get access to Aegis customer base, will get access to the Vopak customer base, access to global know-how for handling all sorts of new products, which I'll go through. And of course, allied to the proven execution capability of Aegis in India for new projects. I think we've demonstrated over the last so many years, particularly the last 10, 15 years, a proven capability of executing on time projects, and I think that's very important thing. And then potential diversification, which I will go through. Next slide is slide 17. Here, this is a slide of what will be the Aegis-controlled liquid terminal capacity increase as a result of this deal. Now, this is not the Aegis Vopak terminal, but it's what will be what we've called the Aegis-controlled liquid terminal capacity as a result of this deal. So in FY21, that is year ending March 21, Aegis controlled 729,000 kiloliters of liquid capacity. I'm not talking about LPG, only liquid capacity. In FY22, post-expansion, even if we did not do this joint venture, we would have gone up to 853,000. Even without this deal, because of the various projects that we have been undertaking in Mangalore and in Haldia and etc., we would have gone up to 853,000. But actually, as a post this in FY22, assuming we close this joint venture with Vopak, because of the acquisition of the CRL terminal in Kandla, the green one, 250,000 kiloliters, we will actually go to above 1 million. Aegis will control through the joint venture as well as its own terminals in Mumbai over 1 million, 1.1 million, 1,103,000 kiloliters. And you can see on the right that 273,000 of that will be retained by Aegis in Mumbai, but the rest, Kochi, Haldia, Pipavav, Kandla, Mangalore, will be as part of the joint venture. So we are breaking through the 1 million kiloliter barrier for the first time, and as I will explain, there is more to go in terms of that capacity increase. In fact, we've got extremely large plans. Now, let me go through those. Next two slides are very, very important. What are the business plans of Aegis Vopak Terminals Limited? Now, first slide is just on page 18, which is just the background, the industry background and the macro trends for the sector that are going on. Most of this is, and it should not be news to you, that India's energy demand is likely to increase by more than those of any major economy over the next 20 years. India has still a very low energy use per capita, 1.4 billion people. So it is widely known in the industry that India's energy demand will very likely increase by more than any other major economy over the next 2 decades. So obviously the growth in energy demand will be higher than in China, which is more developed than India, will be higher than the United States, will be higher than European Union or Japan or anywhere else. But that's really why most companies in this business are very excited about India. And specifically, India's fossil fuel imports, which is a very important part of the business for us, are expected to triple over the next 2 decades, next 20 years, due to the higher energy demand, plus the decommissioning of old Indian refineries. It's quite amazing how many old Indian refineries there are, some of which date back to 1953. Those cannot continue into the 21st century forever. They will be decommissioned. That means that production capacity will come out, domestic production capacity, more imports will happen. So as a result of that decommissioning of old capacity, plus the increased energy demand, the forecasts in the international energy world are that India's fossil fuel imports are expected to triple over the next 2 decades due to these 2 factors. And this, as far as LPG specifically is concerned, that was more to do with fossil fuel imports in total. We have a population of 1.4 billion, but half, 666 million, little less than half, Indians still rely on solid biomass such as firewood for cooking fuel instead of LPG as an efficient, clean alternative fuel. The source of that was the Financial Times newspaper. We know that despite LPG penetrating into most villages and most areas of the country, the reality is that only half of Indians are actually using clean cooking fuels like LPG gas. Most of them, these 660 million Indians, still rely primarily on burning firewood and cow dung and other things like kerosene for cooking fuel, dirty fuels, instead of LPG. So LPG imports will massively increase over the next 20 years in India, and therefore, along with more petroleum and chemicals terminal capacity to handle all those fossil fuel imports, we will need more LPG import terminals. We'll need more capacity, and throughput will be required. That's for the next 20 years. That's the basic attraction of both Aegis and Vopak in this business. A massive amount of extra imports is going to be required, which requires all that kind of import capacity. And Aegis Vopak terminals will definitely be leading this push in India as the #1 player in the market. And what does that actually translate to? We will be executing a number of key, as Aegis Vopak, a number of key strategic connectivity projects over the next 3 to 5 years to produce this step change in throughput volumes of all the LPG terminals towards full capacity utilization. Many of you in our earnings calls have noted the figures of LPG volumes, actually volumes handled, whether it's 3 million tons or whatever the figures, or even on a quarterly basis. We are building up a lot of LPG capacity already. We'll be building more with Vopak LPG capacity. One of the key focuses for the joint venture partners, Aegis and Vopak, will be executing a number of key strategic connectivity projects, which I'm going to go through in the next slide, over the next 3 to 5 years, so that we can reach full capacity utilization in the LPG terminals. And we've identified together with Vopak a number of key projects. That is really crucial, because building capacity but not reaching the full capacity utilization does not mean profits. What all of us are interested, management as well as shareholders, is that how do we get full capacity utilization? And we have answers with Aegis and Vopak of how we're going to do that, which I'll explain a little bit in the next slide. And a very important thing is that we want to accelerate the timetable for rollout of these and other new projects in the next 5 years, from FY23, when the transaction closes at the end of FY22, the 5 years following, FY23 to FY27, using the combined managerial and financial resources of both Aegis and Vopak to really accelerate the timetable for these projects. Now, what are those projects? The next slide. This is probably one of the most crucial slides in the whole presentation. So again, I'm sorry it's taking a long time, but I have to explain this in full. We have sat down with Vopak and really identified a number of very, very key projects in the business plan, in the joint business plan of Aegis Vopak terminals that we're going to be implementing over the next 5 years. And after going through what those projects are, I'm going to give you the figures, at least a range of figures for the CapEx program. First, investing in VLGC compliant jetties. We have noticed over the last few years that if we want to improve the throughput of LPG in our terminals, whether they're in Pipao or whether they're in other terminals, we need to have jetties which can allow the largest LPG ships, very large gas carriers, which carry 44,000 tons. So it's actually important that we just don't sit back and say, okay, sorry, we can only bring mid-sized gas carriers. Today, that's the case in Pipao. And actually, there's a shortage of ships in the world for only mid-sized gas carriers, but there are many, many VLGCs. So this is an important way of increasing the throughput, that we can actually bring larger volumes, larger cargo sizes for the customers. Today, they would like to, and we have to say, no, sorry, the jetty cannot take it in certain cases. That's not going to work out in the future. So Aegis and Vopak have identified a number of jetties, a number of ports where we are going to co-invest with the port operator, or we will do it on our own, the Aegis Vopak, to actually build and operate these jetties. Sometimes build, sometimes operate, sometimes together, sometimes not together, depending on the circumstance. So this is going to be an important part of increasing the throughput, investing in VLGC compliant jetties. Secondly, it comes as no surprise, a further expansion of LPG and liquid tank capacity at existing terminals. So that's already familiar to most of you, that we have existing terminals in Haldia, obviously in Mumbai. It goes on, but this is not part of the joint venture, but in Pipao, etc., that we think we can expand capacity further in those existing jetties. And actually, we've got specific plans agreed with Vopak in this business plan for where and when we are going to expand capacity. And we will announce that when the time comes. But this is, again, part of the next 5 years. But what would be very interesting is, what about liquid capacity? We can expand. We have more land in our land bank in these terminals, where we can expand liquid tank capacity at existing terminals as well. Again, we'll come forward with more plans on that in future. Third, very, very crucial, multimodal transport infrastructure for LPG, including railway connectivity, barges, and pipeline interconnectivity projects. A number of projects that we have identified in various ports to do with Aegis Vopak, again with a view to reducing the delivered cost of imported LPG to the customer. You invest in these projects for a reason, and the reason is to significantly reduce the cost of delivered LPG, imported LPG to the customer, primarily Indian oil, HPCL, PPCL. So a number of projects have been identified by Aegis Vopak, which is why they will be using the terminals more, the competitive advantage of the terminals, and we can increase the throughput. Now, fourth, also very important, for the first time, we are now discussing, and we have discussed with Vopak, construction of inland terminals, inland depots for LPG, to improve the logistics for the national oil companies. I'm not going to say more on that right now, but we are actually we have discussed with Vopak that, look, connecting the import terminals, the port terminals, with inland terminals through the connectivity projects that I mentioned, including rail or pipeline connectivity, or even barges, could transfer imported LPG into inland terminals, LPG terminals, which can then be moved from there to where the customers, IOC, HPCL, PPCL wanted. New LPG terminal in the south, clearly that is also part of the plan of the joint venture company outside of Mumbai, and we will come forward with, Aegis Vopak will come forward with announcements on that in future. Storage of other types of gases, I'll come back to that in a little while, but it includes that why should Aegis Vopak only do LPG, but there are other types of gases, including ammonia, including butadiene, including propylene, all sorts of things where, again, Vopak has know-how, and that could be interesting for customers. And then finally, greenfield liquid terminals to serve dedicated industrial clients, which is what we talked about, that industrial terminals. Now, I did say that what is this CapEx, what is this plan for CapEx, the business plan for CapEx that we've agreed with Vopak. I'm going to give a range. It's going to be depending on which projects happen and which may not happen, or which, if they all happen. We are planning a CapEx program of 2,500 crores to 4,500 crores. Sorry, 2,500 crores to 4,500 crores is a CapEx plan is being that is the range of investment over the next 5 years from FY23 by the joint venture company. Clearly, that will be financed by a mix of internally generated cash flows of the joint venture company. There will be some debt, but it will require some cash injection by both shareholders, that is Aegis and Vopak, as required. Because if we go up to 2,500 to 4,500 crores, clearly the joint venture company on its own will not have sufficient funds. So that is one major answer to, okay, if Aegis is sitting on pre-tax 2,766 crores, some of it will be at the appropriate time. It will remain in Aegis, but at the appropriate time, as required, both Aegis will be recycling some of those funds into the joint venture company, as will Vopak, as required, so that we can do this massive CapEx program of 2,500 to 4,500 crores. I hope that answers the queries already, that what are we going to do with all this cash? Not clearly to sit in the bank account, but it is there to actually implement and finance and implement this massive program of a plan of 2,500 to 4,500 crores of investment in the 7 areas that we talked about. But very specific plans have been agreed by Aegis Vopak as far as this plan is concerned, CapEx program. So I hope that answers that. Future cooperation. So just coming to the last 2 slides, and then we can take Q&A. Future cooperation Vopak. Now, this is also very important. We have agreed with Vopak to cooperate not only on the terminals business for LPG and chemicals and petroleum, but we have also fully discussed with Vopak that, look, we would like to diversify, as far as Aegis is concerned, through this joint venture company into storage of other gases. I already mentioned butadiene. I already mentioned propylene. But there could be a possibility of expanding into storage of ammonia gas, and there could be possibility of storing LNG, liquefied natural gas. These are all products which Vopak is familiar with storing, and Aegis has not been involved in that. But customers are coming to Aegis all the time and exploring whether we could store butadiene for them, whether we could store propylene for them, whether we could store ammonia gas for them. Major customers. Now with Aegis Vopak together, we will be able to go diversifying into these. These are CapEx plans. These are projects which will be beyond that 4,500 crores as and when they come up. And again, utilization of some of the funds that Aegis is realizing, that cash pile of 2,766. In addition, we have discussed extensively with Vopak about exploring renewable energy projects. All of the stuff that we've talked about is storing chemicals and fossil fuels and LPG and LNG and ammonia and all those kind of things. But what about renewables? Clearly, the world is moving. In the next 10, 20, 30 years, there will be renewables. As I explained right at the beginning, Vopak is already taking a lead in certain areas like hydrogen storage, which could be a very, very important business in the future. They're already exploring battery storage, electricity storage through batteries. They're already doing carbon dioxide storage, CO2 storage as part of carbon capture. So these are all projects that we can discuss with Vopak as far as India is concerned. That again, we don't have the know-how, but subject to commercial viability. And the same thing with LNG, the same thing with everything has to be commercially viable. Project by project, we will be in a position to discuss with our joint venture partners, Vopak. And of course, we will also be exploring new greenfield liquid terminals in other ports. I did mention that we are in ports of Kandla and Mangalore and Haldia and Mumbai, of course in Aegis and etc. Pipa. But there are a number of new greenfield liquid projects. Given that huge expansion of import capacity that we will need to go and get land and start building massive new greenfield liquid terminals in other ports. We'll do that together with Aegis Vopak. In terms of financing for these new projects, both companies will finance these larger projects using a mixture of project finance, parent company equity injection. Vopak will inject money into those. Aegis can now, with that cash pile of 2,766 crores pre-tax I mentioned, has the financial firepower and induction or induction of other consortium partners. I mentioned Itochu could be interested. Others could be interested in certain things. For example, LNG could be a billion-dollar project, 7,500 crores project. That's the kind of ticket size. Clearly, we might need consortium partners, and we might need some debt. But now, with the scale of what we can do with Vopak, Aegis and Vopak together, we will be able to do those kind of projects in the future. So it represents a future diversification of Aegis beyond simply LPG and chemicals into other renewables, hydrogen in the next 20, 30 years, hydrogen and battery storage, solar power also. I should have mentioned solar power is something that we are exploring with that. So everything subject to commercial viability, but we can now explore. Aegis will be big enough after this joint venture deal is through with the realization. Aegis will be big enough, not only with the cash pile that we have, but also the huge cash flows that we retain in the retail business and the Mumbai LPG, and of course the dividend flow from Haldia. Aegis will be big enough to actually co-invest with our partners, Vopak and other consortium, into these type of projects in the future and drive growth. Okay, the final two slides. What does it mean in terms of shareholder value, stakeholder value, as far as Aegis shareholders are concerned? Clearly, we will be able to scale up on an unimaginable scale the liquid and LPG terminals business on an accelerated basis. I don't think any of you would expect Aegis alone to be able to plan 4,500 crores of investment in the next 5 years in the liquid and LPG business. We've never done that in the past. With Vopak together, we can plan for 2,500 to 4,500 crores in the next 5 years. So we can do that together. We will obviously be pooling our financial management and technical resources for diversification into other types of gas storage and other types of product storage, combining with the global leader Vopak in a way that Aegis could not do on its own. And we'll be exploring new growth opportunities in renewables and sustainable energy with know-how from Vopak that we don't have. We will combine this with the existing business of Aegis, which means the cash flows from the Mumbai liquid and LPG terminals, the high profits from the 100% owned retail distribution business, and dividend flows from HLPG from the joint venture with Itochu and Vopak, and of course future dividend income from Aegis Vopak Terminals Limited. The way forward, as ever, will be for Aegis to have a very, very strong balance sheet, superbly strong balance sheet, and free cash flows, really a cash-generating company. Aegis will have cash flows from our Mumbai terminals, from the retail business, dividend flows from HLP, dividend flows from Aegis Vopak Terminals Limited. And we will really be focusing a lot on scaling up our retail business. That is going to become a major part of the growth story of Aegis. Beyond the growth of the Aegis Vopak Terminals business, it's going to be a major part of the growth of Aegis, the focusing and growing the Aegis LPG retailing business. And based on the forecast that we have made, we believe this joint venture transaction will significantly, this joint venture with Aegis Vopak will significantly enhance the forecast earnings per share growth post-deal due to the accelerated growth plans of the terminals business with the joint venture Aegis Vopak and potential growth opportunities beyond LPG, including renewables one day and other opportunities. we have made our own calculations that, okay, if we retain the profits, earnings of Mumbai terminals, and we significantly grow the LPG retail business in Aegis, which will be 100% owned, and we grow with the plan of 4,500 capex, all those projects, we significantly grow the Aegis Vopak Terminals Limited profits. 51% of those will come to Aegis, and 51% of the profits, the growth of the Haldia joint venture. We think this will be significantly enhanced forecast earnings per share compared to if we did this on our own with no deal, because of the massive investments that we are able to do with Vopak together with the diversification. So finally, at long last, I can close by saying Aegis, the new Aegis will have three legs. One will be fuel retailing, which we talked about, and focus will, a lot of it will be on the brand building of Chota Sikandar, Aegis Pure Gas and Aegis Autogas, the consumer-facing business. This will become a major part of Aegis, the consumer-facing business of fuel retailing. We will have the joint venture on tank terminals, will be another part of the business, and we'll have new business in the future, looking at renewables and other types of infrastructure that we are not currently in. I think that basically concludes my presentation. I apologize. I had to get through a lot, 23, 22 slides. I can now take questions along with our CFO, Mr. Manudina, and Raj Chindaria, who is calling in from New York. Thank you for listening patiently.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Jiten Doshi from Enam Asset Management Company. Please go ahead.
Anish, many congratulations. This entire deal was a very big surprise to all of us, and wishing you the very best to you and Raj for the successful execution of the joint venture, and to move ahead and demonstrate dramatic growth compared to the last 5 years. My first question is basically on the entire joint venture. Is there a call or put option on either of the sides?
No, there isn't. There's no such clause in the shareholders' agreement on either side. There are standard shareholder agreement things that if they want to sell, but there's no defined call or put option.
So basically, do they have a right of first refusal if you wish to sell?
Yeah, there are standard things. Murad, do you want to just comment on that last part about right of first refusal?
Oh yes, absolutely. Those are standard ones that if we want to exit or if they want to exit, the first right of refusal will always be there to the other partner.
Sure. The second question basically is more related to what is the size of earnings growth that we can visualize in 5 years, Anish, because it's been quite a challenging 3-year period where because of the ESOPs given and because of the pandemic and whatever we saw, I think we were in a build out phase. So shareholders haven't seen a good earnings growth. But when you talk of substantial earnings growth, would you believe that this entire EPS growth could be at least compounding at 30-35% over the next 5 years?
Well, I don't like to give specific numbers, but
no, I think this is just I'm saying a very broad guidance that because
I appreciate. Let me give you because obviously we have our own internal numbers, etc. But let me give you a flavor of what you're right about the last 3 years. I mean, all sorts of things have happened and all that. But we really, with this deal, we really think that we are putting our foot on the accelerator pedal, because with Vopak, we think we can do this kind of major capex plan, but it's not capex for the sake of it. Those particular 8, 9 areas which I mentioned, specific areas, is all a way to actually accelerate the growth in terms of profits. Obviously, we'll have 51% of that, but we think even 51% of a bigger pie with Vopak will become bigger for Aegis shareholders in principle. Number two, we are going to, and this is very much a discussion that I've had with the Aegis management, now that we are, shall we say, hiving off this terminals business into the joint venture management, we will actually, at top management level, be focusing much more in Aegis on the LPG retailing business, which, I can't emphasize enough. It can be so massively scaled up in terms of the growth potential, and of course post-COVID and all that nonsense. We really think that we will be redoubling our efforts, and we will have the management resources to focus on that. Of course, financial resources will not be a problem, but quite frankly, I think it is the management bandwidth is the issue that we will really be able to, and we can invest more in marketing. It's not only in this business, consumer-facing business. It's not only going to be, we need to put bottling plants and we need to put assets, physical assets, like in the terminals business. But this business requires actually brand building and marketing expenditures in the modern way of marketing today, with which will require an investment. And those investments now, of course, we will be able to afford in building out the Aegis branding. So I think those two are there. And last but not least, I think what is very exciting beyond even the next 5 years in terms of earnings per share growth, that I think will be driven a lot, the earnings growth of the Aegis Vopak Terminals Limited, the earnings growth coming from the fuel retailing, LPG retailing, but ability to look at diversifying into new types of gases beyond LPG and chemicals and petroleum. I mentioned ammonia, I mentioned butadiene, I mentioned propylene. There are very specific projects in our business plan. In other words, these are not theoretical. These are very specific projects that we are not in, that we can actually do, and that's part of our discussions, very specific customer requirements that we can now do with Aegis Vopak confidently as part of that investment plan. So I think, and then of course in the future, that may be beyond 5 years, looking at renewables and all that. So I think I've often discussed with many of you, including you, Jiten, that look, the answer to where does Aegis go from here, I think this deal really answers it as much as I've spent the last 2 hours explaining that, or 1.5 hours, that it really answers the question that Aegis is going to go further in the terminals business, Aegis is going to go further in the LPG retailing business, and Aegis is going to go beyond LPG and chemicals. I hope that answers. In terms of specifically earnings per share, no question in our mind. This size of investment that we are envisaging, 2,500 to 4,500 crores of investment, is a far more bigger plan than we would ever have envisaged in Aegis alone. And that means that we are, yes, with a joint venture partner, sharing the risks with us and sharing the profits, but also sharing the investments with us. We are significantly trying to accelerate the earnings per share growth. I would certainly, and this I'm going to say publicly, I would certainly be looking for 25 to 40% earnings per share growth compounding. That would be our target for Aegis Logistics Limited over the next 5 years. In other words, somewhere between, there will be ups and downs, but 25 to 40% earnings per share growth is what we would be targeting for Aegis Logistics Limited as a whole when you consolidate everything into the thing. This would be faster than the growth that average growth that we've had over the last 3 years, but that's what we would be targeting.
Sure. And when you have spelled out some plans for your retail business prior to this joint venture, where you talked of the number of gas stations going to about 200 over the next 3 to 4 years. Now that will definitely change, right? Because you're getting the liquidity and you have the bandwidth. I
think so. I do think so. I'm not yet prepared to say on this call how we're going to upgrade those plans, but we will be. We're already in discussions with our retail team virtually these days. But we are already saying that now that we've got more resources, both management as well as financial resources, and we'll be investing more in marketing. We want to upgrade that plan from what we had before. No question about it. And as soon as we're ready with upgrading that plan, we'll be reporting. But you're right, that those plans are, which will be music to your ears, I'm sure. Those plans are already out of date, and I think we need to accelerate beyond that, just like we're doing on the terminals.
So firstly, I think, thank you so much for this very detailed explanation, and that was very valuable, very useful, very insightful. Just to, further elaborate on that 25 to 40% you're talking about, the your consolidated profits before minority interest. Am I correct?
I'm talking about after minority interest, all profits available to Aegis shareholders only. So after subtracting from Vopak 49% and Itochu, etc., earnings per share available to Aegis shareholders, earnings per share after minority interest, earnings per share, that's what we'll be targeting at the Aegis Logistics Limited level.
Sure. So you're talking about 25 to 40% of that actually growing over the next 5 years, which you have outlined from 22 to 27. Am I correct?
FY20, this deal will close in FY22. So FY23 to 27 is what we are planning. Of course, it goes with the health warning that everything depends on us executing well, not only completing this deal on time and getting all shareholder support for this deal, which I hope you will also be supporting,
sure.
But also executing the projects on the ground well, which we have shown a good track record. Now, with the help of Vopak, we hope to go even better. Nothing is guaranteed. But if we execute this business plan that we've jointly agreed with Vopak together, if we upscale our growth plans in the retail business that I mentioned, then I think that kind of 25 to 40% earnings per share growth for Aegis shareholders, I repeat, after all minority interest, that is certainly something that we are targeting.
So my very last question to you, Anish, is, that your balance sheet size today is about 2,000 crores. And, you're talking about another 4,000-5,000 crores of investment only with Vopak. And then you're talking about in retailing yourself and many new ventures. So when I consolidate all of this in the future, I'll see a, 7, 8, 9,000 crores kind of balance sheet. What sort of return on capital employed would you be looking at? Or what would keep you happy and going in your business?
I think it's a good question. I think in the current circumstances, obviously different businesses have different capital returns. For example, the retailing business is extremely high returns. The liquid terminals is a little lower than the LPG terminals, and other gases may not be as high. But I think a reasonable return on capital would be 20 to 25%. That would be a reasonable return to target with the mix of businesses that we have.
So you're already doing 20-25%. If I exclude the one-time ESOPs, you're already doing about 20-25%, basically in your overall gas business. And if you utilize the capacity from, as you said, from 3 to 12 million, then basically you should be actually looking at a much higher ROC, right?
Yes, but I think I would still leave it at 20 to 25% because the mix of business will change. LPG is a super profitable business, but if we are other types of terminals may not be quite as high. So I think 20 to 25%. But the key thing is here, which I hope you got across in my presentation, is that with Vopak, with the brand that we have, we actually aim to improve the throughput levels of all our terminals, the actual logistics in LPG, for example, with the projects that we need to do. And there are various things that we've discussed with them in detail in the management teams. And that actually will result in potentially even higher returns on capital in the LPG business than we have today. So, I'm just saying that some things will improve, in fact, even compared to today. But if you look at the mix of businesses that we'll have in the future, not all projects will be as high returns. But I think 20 to 25% is a reasonable thing that I'd be happy with. Look, if we do better than that, you'll be happy, I'll be happy, and everyone will be happy. But I think 20 to 25% is a figure that we can live with and we'll be happy with. But if we can do better than that, definitely it'd be great. For example, if our fuel retailing, LPG retailing business grows much faster in terms of sales volumes, then that figure will creep up. No question about it.
Fantastic. No, I think this is very, very good, and we wish you all the very best, and we hope your transaction actually gets consummated by March 22. So the balance sheet that we will see as on 31st March 22 should reflect the entire transaction, right?
Yes, that's what we are aiming for. Murad, I think that's fair, isn't it? That by March 22.
Or is it effective April 22?
No, Murad, do you want to comment on that? What is realistic? March 22?
No, yeah, we are aiming and trying for March 22. And like Mr. Anish said, 75% of the deal would be realized by then. So that would definitely be reflected in the balance sheet, subject to tax deductions, yes.
Sure. So, Murad, we have you after many years on the call. So can you tell us the approximate tax rate? Very.
This is a very complex transaction. And
no, so it cannot be more than 25%, right? It can't be more than 20%.
Absolutely.
Right. So what is the base? I mean, it cannot be less than 10 to, or, maybe, we see many companies, unique companies in India, they pay no tax at all. So,
no, we will not be of that. So,
right. So can I say it's a 10 to 15% range to be very fair?
No, I think 15 to 20 is a much better number.
On the gross sales proceeds.
Yes, yeah.
All right. That was very useful. I wish all of you the very best. Once again, congratulations, and we look forward to, riding this journey and, being a part of this very solid growth story. All the very best to Raj, to you, Anish, and to the rest of the team. All the very best.
Thank you for your kind words.
Right. Thank you.
Yes, and Jiten, if I can just interject here, I know you're always keen to make sure that the entire management team is on the call. Murad is always on the call, and I'm always on the call. But we have a great spokesman in Anish, so we are there to back him up as and when required. So.
Fantastic. All the very best.
Raj is calling in from New York. I'm calling in from London. And Murad,
we'll make sure that Raj is on every call from next time. So that will be great.
He's there at every call. He's just silent, but he's there on every call.
Right, because the company is getting bigger. We need more people to, provide us that confidence. So great. Thank you so much.
It's a little early in the morning, but anyway, that's okay.
Right. Thank you so much.
Okay. Right. Bye.
The next question is from the line of Rajesh Kothari from Alpha Accurate Advisors. Please go ahead.
Hello, sir. Congratulations for this strategic transaction. Sir, I have a few observations. The first thing, you might say as a greedy shareholder, but when we are doing this deal at the enterprise value of 23 times EV to EBITDA on March 22 number, we have done significant capex over the last 3-4 years. But due to, of course, the COVID and such situations, the utilization was actually supposed to start and accelerate further in FY22 and then FY23 and 24. So typically, when we do such kind of transactions, particularly strategic in nature, normally, they do 3 years forward, 4 years forward, because the capex has been already done. Whereas the EBITDA number is not showing up in that, FY20 is too premature, because probably FY23 would have been 890 crore EBITDA instead of, the whatever 570 or 590 crore number of FY22. So, how you see that? That's my first question. And my second question is, from the joint venture perspective, whether the joint venture, how much debt basically will go out from Aegis Logistics balance sheet to the joint venture, and whether the joint venture, as on the date of transfer, would have any other debt apart from the debt which got transferred. I'm saying as on the date of transfer. I'm not talking about the future. Of course, in future it might have its own project finance debt, which is absolutely fine. But otherwise, apart from some debt transfer on Aegis Logistics, is there any other debt which joint venture will take?
Yeah. Okay. Good questions on all. Now, on the first question on valuations. Now, I did mention that the way it was negotiated, like all these valuations, is not only on only 1 year FY22, and just take a figure and then just multiply 23. Actually, what was done was we forecast and they forecast future cash flows for next 10 years. For each unit, which would take into account, when capex was done, and then when things are being commissioned and etc. Taking into account all the growth things, and then obviously use a discount rate, weighted average cost of capital, and then come with valuation, then add it all up and all that. So that was all done, and in fact, there was a lot of haggling and negotiation, which took months. They also did, Vopak did a lot of due diligence, visiting all the sites, looking at asset integrity, looking at whether there need to be some maintenance capex, which obviously is a deduction to the price, because if that has to be done, etc. Although actually they found that there was not a huge amount, because Aegis terminals are in very, very good shape. So all that was done through the normal way of future cash flows and discounting. Now, the reason that I reported the prospective EBITDA of FY22 and then translating that into an implied multiple of 23 is just a metric to explain what the result of those enterprise values that I gave you, that was agreed with Vopak for those units being transferred, what that implied in terms of multiple of EBITDA of FY22. They did not, in other words, they did not say, oh, let's look at FY22 EBITDA forecast and then just multiply 23 and let's pick a number 23, 22. No, that's not the way it works. Clearly, the whole thing was done on the basis of detailed negotiations, line by line, on spreadsheets, on every unit's forecast future cash flows and all that. And I think, obviously, the discount rate then takes into account the riskiness of some of those cash flows, including, for example, new projects like Kandla, which is not even started, which is today just a spreadsheet, right? It has not earned a damn penny. So obviously that is the normal way that has been done. But I think for shareholders and investors, it was a useful way of explaining that what is the implied that enterprise value, the figures I quoted, what is the implied EBITDA multiple on and I think 23 multiple for FY22 is a very good value, and kind of shows that we negotiated a good value from Vopak for this strategic opportunity that they're buying into in Aegis. We are very, very confident of that, and hence how that figure of 2,766 crore comes. It was resulting from all those negotiations over the many months on that. So I hope that answers your question regarding the that it is not just looking at forecast FY22, but it's the way of explaining to all of you that look, when you translate those enterprise values which came out of the discounted cash flow analysis, that what it actually means in terms of multiples. 23 times by any stretch of the imagination is. By the way, I was having dinner with a friend of mine. This is just complete aside. Who runs a business in the UK, and I was explaining to him, and I said 23 times, and he almost choked on his hamburger because he's like, hey, we don't get that in the UK. So I explained to him that India is a little different, that we have high growth.
Yeah,
okay, Murad, I think on the question of debt in the joint venture company and how we intend to run that, maybe Murad, you can respond to that. The leverage in what we've agreed with Vopak in terms of the debt profile for the company. Oh dear, I think Murad has.
Hello. No.
Oh, you're there. Okay, good.
So yeah, to explain the debt profile, what so explained is that the new joint venture will be conservatively leveraged, and there are two control metrics which we have applied for having debt in the JVCo, because it is an infrastructure company and there are lots and lots of infrastructure lined up to be taken up in the company. So the company will be controlled by two control metrics. One is the debt bearing, which is 0.6. It should be in the region of 0.6 and not more than that, as well as cannot exceed EBITDA 5. So that is the control set up by the partners, and both the partners believe it is sufficiently leveraged but conservatively from day one, how it will operate during its lifetime.
Okay. So how much of the debt will be transferred from Aegis to the joint venture?
No transfer of debt, fresh debt. It's all fresh. Nothing. Aegis does not have debt. Oh, yeah, on its books. It is net debt zero.
Well, that I know. I was thinking from the SPE perspective. Okay, fine, understood. So basically that the assets which will be transferred to the joint venture, whether the joint venture need to take any debt to fund this thing, or I'm just trying to understand the structuring perspective.
Yeah, that is what I've said. The structure has been explained, and it depends when, how, and in what manner the partners will decide, and it will happen.
Okay, great, sir. Thank you, sir. Thank you, Raj. Thank you, Anji. Thank you very much. I wish you all the best.
Thank you.
Thank you. Ladies and gentlemen, please limit your questions to 2 per participant. Should you have a follow-up question, we would request you to rejoin the queue. The next question is from the line of Shalin Kumar from UBS. Please go ahead.
Hi everyone, and hi Anish, hi Raj. I'm Raj.
Hi.
Very, very congratulations on the deal. If you allow, I would like to again go through that EBITDA calculation with you. So just one clarification. When you said 176 crores of gas assets, are you taking 100% of Haldia here or only 24%?
Murad, I think...
No, 100%. 100% of whatever business that is going in. Only then we can do 24% down.
You were calculating enterprise value for the whole unit.
No, but Haldia LPG is not going, right? It's only 24% which is going. So it's not going in the JV, right? So ideally, effectively, okay. So then 170.
Shalin, that is why.
No, but the way I'm coming here, that Vopak is paying 2,700 crores, right? Or 2,760 crores, right? Now, what share of EBITDA are we giving them? So I believe 176 crore you said of Haldia of the 3 assets. But of the 3 assets, 2 assets are completely going in there, and 24% is going of Haldia, right? So,
but Shalin, if I can just interrupt, that's why then I subtract from that enterprise value.
But Anish, that's 1,300 crores is let's leave. So 1,300 crores is what Vopak thinks, right? But market thinks on the higher side, right? If let's say Haldia is generating 100 crores of EBITDA, and if we put the same multiple of 23 here, then Haldia is actually much more valuable than what we are expecting from here. Right. So I'm just trying to ascertain 2 things, right? So actually that 176 crore is not 170. It should be less, net, much less. And second thing, so 170 is 2, and then 70, and also CRL EBITDA. We haven't talked about CRL, right? I believe it's an operational unit. So there is some EBITDA coming from that also, which we will be getting it.
Can I answer that? Because Shalin, CRL EBITDA will come, but we'll have to buy and pay for that also, right? So it is not built into 2766. That is only related to our units. The CRL will come once we invest and take over 100% in the JV co of CRL.
So, Murad, how much are we paying for that? Is it at 236 crores?
No, we are paying 186 crores.
186?
Yeah.
Okay, and do we know the EBITDA of that, CRL? If you can disclose around FY21 EBITDA of CRL?
FY22 EBITDA...
21 division? 21 is fine.
Sorry? No. For them also, there are certain things in CapEx which they are doing. So FY22 is what one should be taking. So it is, I think, could be somewhere around 25 crore or so. Yeah.
25 crores EBITDA of the 100%.
Around 22, 25, yeah.
Of the 100% share.
Yeah, of the 100% share. Yes, absolutely.
Yes. So we will be getting 51% of that. So 12 crores roughly. And we are paying 186 crore for that.
Right. So that translates to
15 times. 15 times. So there's an arbitrage over there as well.
Absolutely.
So if I do a rough math of calculation, and so you basically the deal is not at 23 times EV EBITDA. It's by my calculation, and I can complete it now. I think it's on FY22 numbers. You have done a deal somewhere in the range of 26 to 28 times EV EBITDA.
Great, Shalin. We agree with you then.
That's fine. Whichever you show us you're working, but that's even better. But,
We'll be happy to look at it. And anyway, Shalin, we can discuss all of this detailing offline also, because I think
I want to discuss this on the call for the better understanding, right? Because
no problem.
Haldia is a major contributor of that 176 crore, and only 24% should come in that.
Correct.
In the EBITDA calculation, right?
Yeah. You're right.
Actually, if I take 24% of that and both Kandla and Pipavav, your EBITDA contribution should not be more than 100 crores, or maybe somewhere there. So 100 plus 72 is 172 crores is what you're giving, right? Right. So whatever. So that's where it is. So previous participants said that FY22 the EV EBITDA of 23 is lower, but actually on FY22, if we do a ballpark calculation, our EBITDA would be much higher than what, and it's a premium than what we are trading right now. Okay, so that's one thing. And the second bit, in terms of, so why there is a mismatch in terms of the filings? So the confusion, right? So 1486, 314, 236. So, the three filings which you have done and 2,700 crores, there is a mismatch. So, is there a separate agreement?
Yeah, if I can answer that, that is because if you look at it, it is base consideration, because that is how, as per the agreement, we have to file with the stock exchange, and it does talk about adjustments, which we have worked out and then given to the shareholders what would be the final figure. But it has to come when the closing will happen, the exact number will evolve.
Okay. So there is just some premium to it of whatever the base value is.
Adjustments of
Is that
Mr. Shalin Kumar, request you to rejoin the queue, sir. We have other participants waiting for the turn.
Ma'am, just this just a part of the clarification of my second question. So so Murad, just the way to look at it is that the gap, is that something like a premium? It's a part of the deal only. It's just more of a premium kind of thing.
Yeah. Also, Shalin, there are payments which we have explained will happen over a period or after a period of 3 years. So those are not upfront. So they will not appear. Plus the adjustment and plus the final amounts which will evolve on closing.
Understood. Yeah. Understood. I do have one or two more questions. I'll rejoin the queue.
Thank you. The next question is from the line of Alok Ranjan from IIFL Asset Management Company. Please go ahead.
Hi. Congratulations on the deal, sir. Just one clarification and a question post that. So Vopak has also released a notice on this deal. And what they say is that the enterprise value for the Vopak shareholding in the JV will be 185 million euro plus 15 million euro. So that comes to 200 million euro. And they say that the net consideration will be 115 million euro only. But the amount that we are talking about, the consideration that we will be getting is 2,766 crore. So if I adjust with the exchange rate, I don't get the number which we are talking about. So can you just clarify what is the difference in the number quoted by Vopak and Aegis?
Certainly. I think I'm going to hand this over to Murad, who will explain about the adjustments because of the structuring of the deal. Murad, you can take this one.
Yes. If you notice in their filing, they have put in three numbers, which is 115 as well as 40 million, the 3-year payout, and 153 million, the leveraging amount. So if you add up all the three and you multiply by 90, you'll get this amount which we are talking about.
Okay, so 153 million euro, the financing thing, you are saying that will get added into it.
That will flow to us. Yeah.
Okay.
Yeah. So that is exact amount of 2766.
Got it. And the second question is related to the new businesses, which it's quite exciting. It's on the hydrogen and the renewable storage that we're talking about. So is it like in the deal, is there anything mentioned that whenever such kind of new opportunity will come into the India, which they are not doing right now, it has to first come through this JV? That means, is there any right of refusal that will come with the JV and then only they can take it separately, or how is it?
Let me cover that. First of all, it may not come through the JV company because this JV company will be for LPG and chemicals, etc., and other types of gases. But other types of projects, for example, renewables that we talked about, there may be. So they will. What has been agreed with them is that they will. Vopak will talk to us. Quite frankly, it could be us talking to them, and we will then look at the project viability on a case-by-case specific basis. Then we will see whether it's viable. Then we will discuss whether we want to have consortium partners, what is the capital structure, this. So basically it's an agreement to cooperate. Anything to do with these type of things that we put here will be with Aegis to discuss. So, but if finally Aegis refuses that, no, thank you, we don't want to do that, then of course they will go. They can go and talk to somebody else. But their first right of refusal, should we say, is with Aegis. Yes.
Got it. Sir, just a last one, if I can squeeze. These assets are pick and choose by Vopak or like Mumbai LPG and liquid? Obviously, they are very profitable. We have kept with us. So, is this like a pick and choose of assets which is done by Vopak, and is there any strategy related to that?
No, actually, I can respond to it, and I'm going to ask Raj to comment on this, who has been in Aegis longest, and he will have a response. Raj, can you just respond to this question of why you and I discussed it, but why did we decide to retain the Mumbai terminals in Aegis?
Yeah, I think there's a number of reasons. It's a good question. Number of reasons. When and Murad, perhaps you can also intervene here if necessary. When the discussions were going on with Vopak, of course, their preference was to do a complete venture in the entire terminal business, including the Mumbai terminals. Because really that captures the spirit of what we are trying to do here in the entire terminal space, and Mumbai is an extremely important gateway for India. However, we were reluctant to part with the Mumbai terminals because we feel that there is still more work that we have to do. Number one, but to truly capture the value that they would have been willing to pay had they, and we still feel that there was more value there. Secondly, I think there is, a feeling that some sentimentality, perhaps, if you can call it that. This is where the heart of Aegis, where we started everything and so on. So I think for the moment we declined to put Mumbai into this venture. That doesn't mean that it will be off the table forever, but at the moment that's our. So when you say pick and choose, I think the rest of the terminaling assets of India are in the joint venture. So to a certain extent, we picked what we wanted to go in and what we did not want to go in. I don't know whether that captures, Anish, the essence or Murad, the essence of where.
I would just add one more comment to that. When we were discussing, only one more comment, which I think is important for Aegis investors as well. Apart from the 2 points that Raj made about why we retained the Mumbai terminals, it was our choice rather than Vopak for now, is that, look, they provide a very, very substantial cash flow to Aegis Logistics Limited, the public and parent company. And we felt that, look, while cash flows are in the joint venture company and cash flows are in the Haldia company, and of course we'll get dividend income out of them, it's good to have a certain amount of free cash flow in Aegis Logistics Limited to pay for daily expenses, dividends, and for Aegis shareholders and anything else. And that's a substantial cash flow. Along with the retail business, I calculated that FY22 we project 346 crores of EBITDA of the retail LPG business and the Mumbai terminals. So that's useful to have in our system, and I think that was one of the reasons that, look, we still control 100% of those cash flows within Aegis, and I think that's also another reason.
With no claims against those cash flows, no debt, and no other claims on those cash flows other than rewarding shareholders.
Correct.
Yeah, got it, sir. Thank you and all the best.
Thank you. The next question is from the line of Nimish Desai from Kitara Capital. Please go ahead.
Yeah. Hi, Anish and Raj. Congratulations on this excellent deal. Actually, most of my questions are answered, so I wanted to just wish you guys good luck. Only one thing is that on our Haldia HAL, I just wanted to know that even after 3 years, why did we part away on the same valuation of old Itochu valuation? I know you answered that it is based on BCF, and Itochu also in the month of April did the same valuation, but still, why would we give out on the same valuation to a new partner?
Yeah, it's still a good question, obviously, and worthwhile asking. So let me answer it like this. Look, 3 years later, after we commissioned, everyone had a fresh look at Haldia LPG terminal, and including Itochu, when they were buying an extra 5.3% stake in April of this year, and Vopak, independently, obviously, they didn't discuss. And then everyone can make certain projections going forward. And now, a very significant factor for everybody was that, look, BPCL has gone out, as I mentioned. So now we are the terminal's value is related to throughput volumes from one customer at the moment only, which is HPCL. So I think one customer is not as good as two. And therefore, I think probably it was felt independently by both Itochu as well as Vopak. And we discussed with them, we negotiated independently, and both came up with reasonably similar valuations. So it's not an arithmetical law that, just because it's 3 years later, the value will go up. Things have changed. One customer has gone out, some things will happen, this, that. And I think both companies, Vopak as well as Itochu, independently came up with similar kind of figures, and we ended up negotiating what we felt was a reasonable value of around 1,300 crores, which we felt was reasonable. And as you all know, who follow the quarterly volumes although I don't break it out exactly for every terminal, but definitely the volumes have fallen in Haldia since VPCL has gone out in the last 2 quarters. So, that all is all reflected in this valuation. Now, going forward with Vopak and with Itochu, we have got plans to do further things in this entity. And it's only fair that when we do those plans together with them, and I'm talking about the interconnectivity projects, I'm talking about barge projects, I'm talking about all those things, that they share in any extra value created with that. But right now, those are not facts on the ground. Right now, they are not there. So I think all of this is reflected in the valuations that were agreed to finally between the various parties.
Also, I think if I may, sorry.
No, I was just going to add finally. I really do think we do see Vopak adding value, and so did Itochu, by the way. Their own value coming into things. I won't go into the details, otherwise I'll bore you to death. But they've got various ideas on how we can improve, let's say, throughput volumes in Haldia compared to what they are today, etc. So I think, quite rightly, they should also, when they bring those ideas and add value, they should also share in that wealth creation, shall we say.
Thank you. The line for the current participant is disconnected. Ladies and gentlemen, please limit your questions to 2 per participant. Should you have a follow-up question, would request you to rejoin the queue. The next question is from the line of Priyankar Biswas from Nomura. Please go ahead.
Congratulations, Anish, and the entire team for this deal. My question is, when I am looking at the Vopak press release, of course, they are doing at a valuation, they are suggesting a valuation of 11 times EV/EBITDA. I mean, on calendar year CY22 and 8 times CY26 probably. So, and they are speaking of a somewhat lower revenue growth also. So, is there some way we can reconcile the numbers that you have given and what they are suggesting? I mean, where is the gap I am trying to understand?
Murad, do you want to take that one?
You see, they probably are not looking at any growth investments, and we are not privy to their workings. But we have tried and explained to you or to the investors that this is the way we see it. Now, I think that's about it, because probably in their workings, they might be having some costs which they appropriate, probably.
So adding on to that, just one small question here. So can you give me, probably I missed this, maybe you would have told it, what will be the Haldia EBITDA overall?
No, we give for all LPG, Kandla, Pipavav and Haldia together, which we have said, I think 176
crores.
Yeah. And then 72 crores of liquid terminals, and then there would be around 20-25 crore of CRL.
No, the reason I was asking, because since Haldia had a different calculations of this 1300 crores, so wanted to know that what was the implied deal value for that? I mean, that specific asset.
We are not giving those numbers split between terminals.
Okay, sir. That's all from my side.
Thank you. The last question is from the line of Sarfaraz Bhimani from Motilal Oswal Financial Services. Please go ahead.
Yeah, hi sir. I just had one question. So you said that we are yet to receive this 198 crores, which is based on, say, revenue targets over the next 3 years. And when you gave the split of, say, the cash that will be coming to Aegis, you said 75%, which is 2,074 crores, will come on Aegis' balance sheet, and remaining 25%, which is 692, will be paid directly by Vopak. So can you just give me the maths of 692 crores, please? Because I assume it to be 198 only, which is on revenue recognition. So
yeah, I think I will do that. So suppose this 198 is contingent on revenue. So out of the 692, 198 is dependent on revenue, achieving revenue projections, which we have said. Balance, we will surely get it at the end of 3 years.
So balance, you mean around 400 odd crores will come, 500 odd crores will come at the end of transaction period only. 400
odd crores, yeah.
Yeah, and any particular reason
at the end of 3 years.
Okay, and any particular reason for the same, that why are we not getting that 2,400 odd crores together at once?
This is the way transaction has been negotiated and structured. So there is it's all negotiation. Yeah.
Sure, thank you so much for that answer.
Thank you. Ladies and gentlemen, due to time constraint, we would like to end this call now. I would now like to hand the conference over to Mr. Anish Chandaria for closing comments.
Okay, thank you very much. I apologize, there was a lot to get through, but I hope we have answered the bulk of the questions. Orient Capital through Payal will be organizing, more detailed discussions for those major investors and brokers who would like to get in touch with her. But basically, I just want to summarize. This major deal allows us to, one, massively increase our growth plan in the existing terminals business, LPG and liquids. As I said, a range of 2,500 to 4,500 crores over the next 5 years. We would not have been able to do this on our own, Aegis, to that extent, 2,500 to 4,500 crores, but we are able to do it allied with Vopak. And we, as I said, we've agreed a joint list of specific projects, strategic initiatives and acquisitions that is in the business plan, and as part of that, Aegis will be reinvesting that 2,766 crores of cash into the various projects as required. The second thing that I mentioned is that it allows Aegis to diversify into storage of other gases, which we are not currently handling beyond LPG and chemicals and petroleum, such as LNG, possibly ammonia, butadiene, propylene, etc. It also allows Aegis over the next 5, 10, 20 years, 30 years to explore renewable projects such as potentially hydrogen storage, electricity storage through batteries, and other mega projects which we will now have the financial firepower to do in a way in which we could not do alone. This also is part of the deal with Vopak. And finally, something I've mentioned in passing, but let me just reiterate, this joint venture with a global brand leader, Aegis Vopak, will help us attract new multinational clients and a more powerful brand, Aegis Vopak, including with national oil companies, including Middle Eastern NOCs, as well as Indian Oil, HPCL, BPCL. The Aegis Vopak brand name will be a very powerful force in this market for years to come. So I hope you all support this deal. We've tried our best, a complex deal, and we've tried our best to explain it. But I think the main message that I give is it's a massive growth shot in the arm for Aegis Logistics Limited, not only because of the growth in the terminals business, but also we will be focusing on the retail business. And we hope, therefore, that this will be significantly earnings enhancing in the years to come. Not only for the next 5 years, but 5, 10, 20 years. We've answered a lot of questions of where Aegis goes next. Thank you very much for attending. Goodbye.
Thank you. On behalf of Aegis Logistics Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.